90 days ago, I handed over complete control of my investment portfolio to an AI. No human advisor, no gut instinct, no panic selling at 2 a.m., just cold, emotionless algorithms making every single buy and sell decision on my behalf. And what happened next genuinely surprised me. Because the AI didn't just beat the market, it also exposed something deeply broken about the way most people invest. And nobody is talking about it. We are living through the biggest shift in personal finance since the invention of the index fund. Right now, AI-powered investment tools, things like Robo-Advisors, algorithmic trading platforms, and machine learning portfolio managers, are managing over $1.4 trillion in assets globally. And that number is doubling every 2 years. But here's what nobody tells you. Most people using these tools have no idea how they actually work, what the real risks are, or whether they're even legal to use without a financial advisor. So I decided to find out the hard way. I started with a real portfolio, real money, real stakes. I picked 3 AI platforms, a Robo-Advisor, an algorithmic trading bot, and a newer large language model-based tool, split my capital between them, and let them run for a full 90 days without touching a single thing. This is everything that happened. The gains, the losses, the moments I almost pulled the plug, and the one thing that changed how I think about money forever. Before we get into the results, you need to understand what I was actually testing. Because not all AI investment tools are created equal. Platform 1, the Robo-Advisor. This is the oldest and most mainstream category. Think Betterment or Wealthfront. You answer a questionnaire about your goals and risk tolerance, and the AI automatically builds and rebalances a diversified portfolio of ETFs for you. Low cost, low drama, boring on purpose. I gave this platform a moderate risk allocation, 60% stocks, 30% bonds, 10% alternatives. Platform 2, the Algorithmic Trading Bot. This is where things get more aggressive. These bots execute trades based on preset rules. Things like moving average crossovers, RSI signals, and momentum indicators. They can make dozens of trades a day, and they don't sleep. They don't second guess. They just execute. I gave this one a smaller slice of capital because the volatility can be brutal. Platform 3, the LLM-based Portfolio Manager. This is the newest category and the most controversial. These tools use large language models to read financial news, earnings reports, and macroeconomic data in real time and adjust positions accordingly. It's the closest thing we have right now to a machine that thinks about the market. I treated this one as the experiment within the experiment. The first 30 days felt almost too easy. The Robo-Advisor quietly rebalanced my portfolio twice, once after a market dip in week 2 and once when bond yields shifted. No drama, no notification, it just fixed itself. The Algorithmic Bot was more active. In the first month alone, it made 47 trades. Most were small, a handful were significant. By day 30, it was up 4.2%, well above the S&P 500, which gained 1.8% in the same period. And the LLM Portfolio Manager? It did something I didn't expect. On day 11, it moved 30% of its holdings into defensive sectors, utilities and consumer staples, without any trigger I could see. I thought it had malfunctioned. 4 days later, a major inflation report came out worse than expected, and the market dropped 3%. The LLM tool had read the signals before the headline even existed. I was impressed, and honestly, a little unsettled. Month 2 is where the experiment got real. The algorithmic trading bot hit a rough patch. It was built on momentum signals, meaning it bets on trends continuing. But in weeks 5 through 7, the market kept reversing. Every time the bot positioned for an upward move, the market faked it and went the other way. By day 52, the bot was down 6.8% from its peak. This is the moment most human investors panic. They see red, they pull out, they lock in the loss. I had committed to not touching anything. So I watched. Meanwhile, the Robo-Advisor did exactly what it was designed to do. Nothing dramatic. It didn't chase the dip. It didn't overreact. It trimmed a few positions and bought more of what had fallen cheapest. A strategy called systematic rebalancing that most investors understand in theory, but almost nobody has the discipline to actually execute. The LLM tool also wobbled. It made 3 rapid position changes in a single week, something its interface flagged as elevated market uncertainty response. Translated from algorithm speak, even the AI was confused. This period taught me something important. No AI tool is immune to volatility. The difference is that they don't let emotion make a bad situation worse. By day 70, something interesting started happening. The trading bot, the one that had been struggling, began recovering. Not because the market saved it, but because its underlying logic started matching market conditions again. It went on a run of 11 consecutive winning trades. The discipline of sticking to a systematic strategy, even through a losing streak, is something humans intellectually understand, but almost never actually do. The LLM tool found its footing too. In the final 3 weeks, it rotated heavily into energy and technology, a move that, in hindsight, was perfectly timed ahead of a positive jobs report. And the Robo-Advisor, it just kept doing what it always does. Slow, steady, methodical. By day 90, here were the final numbers. Robo-Advisor, plus 7.1%, just ahead of the index Algorithmic Trading Bot, plus 11.4% after nearly breaking me in month 2 LLM Portfolio Manager, plus 9.8%. With the most volatility but the most interesting decisions. Compare that to what would have happened if I had managed this myself. Based on my own instincts during that turbulent month 2, I would have sold during the dip and locked in a loss. The AI didn't just beat my returns, it beat the version of me that would have panicked. Here's what. 90 days of watching AI manage money taught me that no finance book ever did. The biggest enemy of your wealth isn't the market. It isn't inflation. It isn't even bad stock picks. It's you. Study after study shows that the average investor earns 2 to 3% less per year than the funds they're invested in, simply because they buy high and sell low. They react to fear. They chase trends. They check their portfolio every day and make emotional micro decisions that compound into massive long-term losses. AI eliminates that problem entirely. It doesn't watch the news and feel dread. It doesn't sell at 3 a.m. because it had a nightmare about losing money. It doesn't remember that one time a stock ruined its life. It just executes the strategy every single time. Now, is AI investing risk-free? Absolutely not. The trading bot proved that. Algorithmic strategies can fail. LLM tools can misread data. Robo-advisors are not magic. They're still exposed to market downturns. But for the vast majority of everyday investors, the main thing standing between them and building real wealth isn't access to better stocks. It's the ability to stick to a strategy through fear and uncertainty. And that is the one thing AI does better than almost every human alive. So where do I go from here? I'm continuing the experiment, but this time I'm raising the stakes and adding a 4th platform into the mix. If you want to follow along as this unfolds, subscribe and hit the bell. Every update will drop here first. And if you want to know exactly which platforms I used, the full breakdown of fees, risks, and how to get started yourself, that video is linked right above this one. I'll see you in the next one.